Are inflation indicators turning against the Fed? Fed Chairman Jerome Powell gave his speech at the annual Jackson Hole Economic Symposium. He noted the sharp run-up in inflation in the months leading up to the conference. However, he relaxed concerns and suggested that these high inflation figures were transitory, meaning it would only persist in the short term by pointing to 5 different indicators. Based on those 5 indicators, Powell stated that he expected inflation to return to the Fed's target 2% rate over time. It's now been 3 months since Powell took his stand, and yet inflation has gone in the exact opposite direction. In October, the annual inflation rate in the U.S. shot up to 6.2%, the highest rate recorded in over 30 years. Opinions on Wall Street are still divided on whether or not we'll see the return of the dread specter of stagflation that haunted much of the 1970s that brought the bell bottoms to style. But there's one thing that every analyst can agree on. Powell's transitory isn't going to be quite as short as most would like to believe it will be. And to see why, look no further than the same 5 indicators that Powell referenced when he gave his speech. So let's go through all 5. Indicator number 1. The absence of broad-based inflation pressures. The first data point Powell pointed to when making his case against inflation being around to stay was that inflation was primarily being driven up by the prices of a narrow group of goods and services that were directly affected by the pandemic and the reopening of the economy. The most recent data for October, however, points a different story. With many different types of goods showing remarkable price increases over the past 12 months, we decided to put together a chart for you on the annual inflation for select items like used vehicles, things that are pretty important for you and your family like food such as meats, poultry, fish, and eggs. You need electricity to stay warm and heat your water, and eating out and transportation services, and somewhere to live like housing. And you can see across the board, every single one of these is much higher than the Fed's target of 2%. You know, when food is over 10%, you got something to worry about. There are now a wider array of goods driving inflation up. Beef, for instance, is up 20.1% since the same time last year. And some will say you want to go vegan. Well, I've been there and done that. And guess what? Vegan food's up over 20% inflation. So, indicator number 2, moderating inflation and higher inflation items. You've no doubt noticed that many goods and services that were impacted by the pandemic rocketed up in price, but have since moderated somewhat in the wake of the recovery. So let's talk about some. For example, used vehicle prices were up at 45.2% earlier this June, but have since overall improved to a somewhat more reasonable 26.4% price increase for those same used vehicles. Commenting on this, Powell specifically mentioned that inflation in durable goods other than autos had slowed and was expected to fall, which would help lower overall inflation in turn. So we decided to put together a little chart here for you. So here's the durable goods implicit price deflator. That's the index going back from 2012 as your base. So, however, the most recent quarterly data from the U.S. Bureau of Economic Analysis shows that not to be the case. That's interesting. So the Fed and the U.S. Bureau of Economic Analysis are saying different things, with another 2.3 increase in durable good prices from July through to September. Recent increases in prices of durable goods continue to reverse a decades-long downwards trend that began in the mid-90s. And it's still unclear as to when exactly this trend will resume as Powell expects it to. The next indicator, wages. At the time of Powell's speech, there was little evidence of wage increases that would threaten excessive inflation. Citing broad-based wage measures like the Employment Cost Index and the Atlanta Wage Growth Tracker, Powell noted that the increases in wages matched the Fed's long-term inflation objective. So we put together this wage growth since 2010. The blue line's the Atlanta Wage Growth Tracker, and the green is the Employment Cost Index. But the devil's in the details. More recent data from the same sources Powell was referring to shows that wage increases have only continued to grow. The quarterly Employment Cost Index saw a record jump in the quarter ended September 30th. The Atlanta Wage Growth Tracker, 3-month moving rolling average, also broke past the 4% mark for the first time since just prior to the global financial crisis. At this rate, it's quite likely that rising wages will continue to act as an inflationary pressure for the months ahead. Most recently, a large union just got a 10% increase across the board. The trend is your friend. Indicator number 4, longer-term inflation expectations. It may sound like a self-fulfilling prophecy of sorts, but what people think about inflation can be just as impactful as the rate of inflation itself, kind of like a placebo effect. When people think high inflation is on the horizon, they'll stock up on durable goods and look for higher paying jobs. On the other hand, companies will look to trim costs and raise prices, and these actions can lead for further inflationary pressures. So managing inflation expectations of people is very important to the Fed as well. So we put a chart here to actually explain this visually. Look at the inflation expectations since the bottom of the crisis. How does the Fed monitor consumers' expectations, you may be wondering? Well, the University of Michigan's monthly Consumer Inflation Expectations Survey is one of the sources the data Fed relies upon to check what the people think about inflation. Unfortunately, for the last several months in a row, this survey has consistently shown that people are still expecting inflation in excess of 4% in their future. And that's the first time in over a decade. This should come as no surprise either if you think about it. Inflation is driving up prices across a broader base of goods and services, and hence becoming much more visible. And the last indicator the Fed uses is global disinflationary forces over the past 25 years. You see, Powell closed out his segment on inflation saying in the last 25 years, most advanced economies in the world, not just the US, had kept their rates of inflation at or below the 2% waterline. He attributed this to a number of global disinflationary forces driven by changes in technology, globalization, demographics, and central bank policy. But things aren't exactly rosy everywhere else in the world either. Let's take my hometown of Canada, which saw a near 20-year high inflation record in October, while it was a 10-year high in the UK. Over in the EU, the Eurozone, inflation hit levels not seen since the global financial crisis over 12 years ago. And while China may look like it's doing fine, that 1.5% rate is a 13-month high for China's CPI. China's numbers also hide a more concerning figure. China's Producer Price Index, PPI, which tracks the cost of goods when they leave their factories, jumped 13.5% for October, up from 10.7% in September. That's a big jump. It's a warning sign that the rising prices might soon be getting passed on to consumers both domestic and abroad. As inventories get depleted and replacement costs rise, China might soon be seeing the exact same inflation woes already dogging the Western economies. It's hard to say whether this will significantly weaken the global disinflationary forces that Powell spoke of. The cost of imported goods is going up, certainly won't help lower inflation. So how short is transitory anyways? With most of Powell's indicators now going the wrong way, it's clear that the inflation we're seeing isn't going away by itself anytime soon. Plus, policymakers and economists tend to view monetary and fiscal policy on the timescale of years, not weekly like when you go to the grocery store to buy food for your family. So soon to them probably isn't the same soon to you or the soon you want to hear. Many commodities around the world are still suffering from supply and demand imbalances, infrastructure imbalances, and permitting delays, in many cases brought on by the coronavirus pandemic. But as the Chinese would say, you can't spell crisis without opportunity. For those who aren't in the know, the Chinese word for crisis includes the character for opportunity. While the coming months of high inflation might mean more expensive groceries and fill-ups at the gas station, it might also mean the chance of a lifetime for your investment portfolio. To learn more about the market forces at work in our global economy, as well as the best way to leverage your portfolio to profit in both good times and bad, consider learning more about my premium newsletter, the KRO, Katusa Resource Opportunities. Every month, I outline market sectors that are flashing signals to pay attention to, including companies that I'm buying and where I'm putting my own money. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. and you get to excel before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.